Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host, Pushpendra Mehta. Joining me today are Anthony Carfang, Managing Director of the Carfang Group, and Ben Poole, writer at CTMfile.
Pleasure to be here. Thanks, Push.
Glad to be here today, Push.
Thank you so much. It's time to get some deeper insights from you on our topics for today, namely real-time payments, India and the US, API connectors and real-time payments, payments fraud and banking failures and recessionary pressures. Our audience can read these articles and also research content more deeply by visiting ctmfile.com or by following the links in our show notes. Let's get started with our discussion. Our first story for today is about real-time payments, India and the US. While real-time payments have profoundly changed the way consumers, businesses, and governments make and receive payments and conduct their financial affairs, as per ACI's latest report on real-time payments, the world's largest economy, the US, continues to lag in real-time payments. India, on the other hand, which is considered the world's largest democracy, spurred by its homegrown instant payment system, has surged ahead as the global leader in instant payments. In fact, BlackRock chairman and CEO Larry Fink, in an annual letter to investors last month, took a jab at the US payment system and said the US is lagging behind in innovation, leaving the cost of payments much higher. Tony, if I may start with you, given what you have read of the article and in light of India's surging dominance in the real-time payments market, how do you think this will affect FedNow and the competitive landscape in the Western world in terms of global payments and corporate treasury services?
Well, Push, clearly real-time payments are going to happen, and they're going to happen everywhere. Every country is coming from a legacy infrastructure of varying degrees of quality. So when we look at the dominance of the real-time payments in India, that's actually fairly logical given that the legacy infrastructure left a lot to be desired. And particularly in peer-to-peer payments, with consumers now rapidly moving to the iPhone technology or whatever, that is a natural. Well, you contrast that to the U.S., where the legacy payment system was actually very robust. Fedwire and ACH, and frankly, we Americans, I still wrote a check, and the system was working, and therefore the need to make an order of magnitude improvement was less. Now, having said that, the benefits are huge. Because with real-time payments, not only do you get instant information, but that you have a good audit trail. You have a much better way of reducing risk in the system. Time introduces risk. So if the time for the payment to settle is collapsed, the risk that can happen during that chain is collapsed as well. There are a lot of reasons for real-time payments overall. But then I can understand how countries like India, Thailand, Brazil would be leading in terms of the greatest growth in this area.
Well, something that I thought is quite interesting in this space is there was some news that came out in the past week around India's central bank ending plans for a project that was intended to rival UPI in the country. I think the project going under the name like the New Umbrella Entity, or NUE, had initially, I think, attracted interest from a variety of tech firms and financial institutions, the likes of Amazon, Facebook, Google, and more on that scale, going back to 2021, which, of course, if you think back, that's only 2 years ago, but the transaction volumes on UPI were nothing like what they are at the moment. So it sort of made sense, I suppose, to appeal for, possibly a rival real-time payment system. But what we heard from the Reserve Bank of India's deputy governor was that the project's potential participants hadn't proposed any innovative or infrastructural solutions. He was really emphasizing the fact that the whole idea was to go beyond just these simple steps in improvements and actually take a leap ahead. Now, in those 2 years, and in your brilliant article, Push, that you really highlight how the transaction levels on UPI have skyrocketed in the recent year or two, I suppose there's a certain argument that maybe, are you concentrating risk by just having the one payment system? Obviously, in the RBI's thinking, there wasn't enough going on in the quotes and the proposals they received to justify launching a second instant payment system. But you mentioned the US as well. You contrast that with the US, where you've got FedNow, which is launching in the summer. Obviously, there's already RTP in the US. So if you've got two instant payment systems, do you sort of bolster the security by having an increased access to 24/7 real-time payment services? Obviously, you could get some competition in that space as well, which can drive innovation. So that's kind of interesting. And you look at FedNow when it comes to transaction limits. I think the limit when FedNow starts is going to be $500,000 compared to RTP's $1 million. So you think, well, maybe is that less relevant to corporates when you think about the large ticket items that they're moving cash around for? That should also be fine, because if you look elsewhere in the Eurozone, for example, with the SCT INS limit, that's in most countries in the SEPA zone, that's 100,000 euros. So I guess FedNow isn't looking too shabby in that regard.
It's interesting. Ben puts his finger on a lot of really important issues that I think you can look at that in terms of what happens when activities are undergoing disruption. And we're seeing fits and starts, and we're seeing multiple approaches. We have different dollar limits in different jurisdictions, or different payment limits in different jurisdictions. The UPI sounded like a panacea because everyone would be on the same standards and everything, except it wasn't. So, I think we're going through the normal stages of evolutionary disruption. I think things are proceeding apace.
Those are very, very interesting insights, Ben and Tony. Moving forward to our next story for today, which revolves around Kyriba and U.S. Bank announcing that they are working together to ease the process of enabling real-time payments for businesses. With new API-powered payment connectors, clients of both U.S. Bank and Kyriba can now send instant payments to vendors, customers, and employees from their U.S. bank accounts within their existing Kyriba dashboard. Ben, if I may ask you to go first on this question, according to you, what are the key benefits that Kyriba and U.S. Bank's new API-powered payment connectors bring to corporate treasury?
Well, I think this is a really good topic to have straight after our first topic, because it's giving you a practical example of what actual players in the market are doing to enable real-time payments and use these real-time payment rails for their customers. Obviously, for this specific story, if you are a corporate that has Kyriba as your TMS, for example, and US Bank is part of your banking group, then you'll be able to have your transactions go out faster, be credited faster to the people that you're paying. So that's good news for them. I think for corporate treasurers, real-time payments all comes down to thinking about and finding specific use cases for their business. Obviously, every business is different. It can depend which industry you're in, which country you're in. Use cases cover a whole lot of ground. For example, if you offer insurance as part of your business, then instant payments are advantageous, because if a person has put in a claim and they really need the money, you're getting it to them instantly and not 2 days later when they might be in trouble for whatever reason. You can look at refunds. If you're a retailer, if someone takes something they've bought in your store back for a refund, they want that immediately because they're taking the item back. But obviously, if you pay with a credit card, that can take a day or two to be refunded. I know a case in France where SocGen has partnered with a payment association to enable instant refunds. So basically, the salesperson just enters the information into their system, and then through an API, and I think APIs are very important in progressing the interconnectivity here, that refund is immediately generated. And because it's in France, obviously that's with the SCT instant payments. rails. So there's lots of use cases, but it's all about treasurers and understanding their business and looking at where they can really make the most of the real-time payment rails as and when they're made available to them.
Ben, you have a lot of insights in there. Kyriba and U.S. Bank's partnership is an example of use cases, and then you talked about many other use cases. I think that is actually a feature of how innovation happens in a developed framework, as opposed to some of these other countries that are doing this from a clean slate. And so it's almost of necessity. When you think about what Kyriba is doing with U.S. Bank for the joint customers of Kyriba and U.S. Bank, I mean, how many cells are in that matrix? How many technology vendors along the rows and banks across the columns and customers in the middle need to be satisfied in an already developed payment system? To disrupt that, you need the use cases for every one of those cells. It gives you a sense of just how big the issue is. I'm not going to say the problem, but the hurdle is in some of the developed countries that already have robust payment systems to get to RTP. The difference between a settlement that takes a few hours versus is instant is obviously huge in some situations and irrelevant in many, 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 many others. And that is the challenge that we have getting growth in RTP in the developed economies.
Those are very valuable insights, and I hope our audience was paying attention to what Ben and Tony had to say about this particular partnership between Kyriba as well as U.S. Bank.
Push, if I could add one more comment there, in some of these applications with the technology vendors who particularly dealing within a supply chain, scheduling payments kind of meets the need of real-time payments. If a payment is scheduled to take place at 11 a.m. in a certain time zone in a specific amount at a specific bank, what do I care when it was initiated? If I'm the receiver and I'm going to have payment at 11 a.m. at Citibank in New York in account number 12345, I don't care when you initiated it.
That's a great point. And it would take I think you'd have to be quite a sophisticated treasury, maybe, to be able to really accurately, sort of very precisely seed future payments. Maybe you've got like payments on behalf of, collections on behalf of structure, something like that. And there's a real sort of benefit there of being able to seed those. So if that's a possibility, that just shows that's another use case, isn't it, of what can be done.
Another discerning thought from both of you. And I hope, like I said earlier, I hope our audience is paying attention to that in particular. Our next story for today is about the rise of payment fraud. Corporates and banks face ongoing need for protection against fraud, with 73% having been impacted in the past year, according to Bottomline Technologies and Strategic Treasurer's 2023 Treasury Fraud and Control Survey. On a more positive note, over half indicate they are in a better position to battle fraud than last year. However, the poor protection of the custody of sensitive payment files across a company's network remains a massive exposure, warns Craig Jeffrey, managing partner and chief researcher at Strategic Treasurer, a leading treasury and risk management consulting company. Upon review of the Bottomline and Strategic Treasurer's 2023 Treasury Fraud and Control Survey news story, Tony, what would your areas of concern or focal areas be if you were a corporate treasurer?
If I'm a corporate treasurer, I would want as few points of vulnerability in the payment process as possible. And I would be mapping out the entire front to back process of initiating a payment. I want to make sure that passes through as few channels, as few points of failure as possible. And I think that working remotely or working in decentralized situations actually adds points of vulnerability which heightens the need for more diligence throughout that process. It's very tricky because those who are seeking to subvert payments have so many different ways of doing this. Social engineering or emails, phishing emails, and diversionary tactics and whatever. And they are always going to be a step ahead because for them, the risk is asymmetric. The likelihood of getting caught is very small. The likelihood of winning big, can be very, very high. So that element will always be attracted to the payment system. That means that corporate treasury needs to be vigilant at every step, every point of vulnerability in the process.
Ben, do you have similar thoughts?
Yeah, I think Tony outlined that really well in terms of, minimizing areas where you are vulnerable and also having processes in place that sort of back up and support those weaker points. Really interesting reading the survey and seeing that business email compromise was by far sort of the most attempted corporate payment fraud. Back in the day, fraudsters would go after the banks because that's where all the money is. But clearly they've realized that corporates are a more softer touch. They don't necessarily have the grade of security in place that financial institutions do. And it just underlines, that the most robust technology defenses possible can be, guarding you, but it's the human element that is and will always be the weakest link. So just having processes in place and education so that everybody understands, if you get a panicked fax, if people are still using faxes, 2 minutes before the end of the workday, purporting to be the CEO or the CFO, you need a process in place just to double check because, anyone that is a CEO or CFO won't mind just clicking yes, accept on the other end, as long as you're making sure that you've got the right number to contact them back on and you're not taking what's on the fax. So there's a lot of thought that needs to go into it, but just working on those processes, refining them and education, I think is so important.
I'm glad you touched on the human element because spurring human intelligence primarily through training is probably the most important, the first thing to do. And it needs to be, as you said, regular and ongoing.
Sorry, Push. I'll just jump in with one other point that I was thinking about. Obviously, because we've been talking about instant payments a lot, and there's an issue, of course, if an instant payment gets rejected by a bank, say it's flagged as suspicious, these are best of intentions, but they can sort of hamper what the Treasury is trying to do. So that's an area that's quite interesting to look at. I know that certain banks in Europe, for example, are looking at ways to degrade an SCT inst payment if that happens. So what that basically means is they wouldn't outright reject the payment, the instant payment, but rather they push it off the instant rail and back to the sort of the classic SEPA credit transfer rail. So they've not cancelled the payment, but it gives more time to investigate those suspicions while avoiding cancelling valid payments and creating that extra work for treasurers. So that's work that's ongoing. I think it's not a solution that's in place yet, but I mean that's another interesting area around instant payments to think of when it comes to real time and fraud as well. So good to know that that's being worked on as well.
Our next story that merits discussion pertains to Jamie Dimon, JPMorgan CEO, saying that the recent banking crisis has increased the chances of a recession and is expected to have repercussions in the form of new regulations. Ben, from where you see it, do you concur with the JPMorgan CEO when he says that the recent banking crisis will add to recessionary pressures as well as new regulation?
Well, it's interesting, isn't it? We're sitting here on the 11th of April, and obviously a lot of the banking turmoil that happened was 1 month ago in March. So in one sense, we feel, quite detached from it already. It's kind of, about a month has gone by. But actually, I still think we are in the kind of the fallout stage, not the necessarily sort of a banking fallout stage, because Credit Suisse, just to pick on them for a second, obviously among analysts, I think it was seen for quite a long time as the weak link among the major European banks. And, while central bank rates have been rising, I think that might create perhaps higher defaults within loan books of banks. But I think overall banks are quite well capitalized and managed compared to the state they were in. If you go back to 2007-8 and the global financial crisis, the sort of the raft of regulation around capital provision and things like that to try and shore up the banking sector after that has in part been shown to be successful, obviously not in every case. Also, when you look at the banking turmoil, it's really added to the economic tightening that was going on in economies all over the world. And it was almost like a stealth rate hike in itself. So that's like another factor that central banks have to think about when it comes to their monetary policy. And then obviously the knock-on effect of rate movements for corporate treasurers to think about as well.
Jamie Dimon said, let's catch our breath before we decide to jump in with regulations. Truer words have never been spoken. In the immediate aftermath, it's easy to look on the surface at what happened and say, well, we need to put a limit on this or a cap on that, and we got to prevent something else from happening. I think when this is dissected, we're going to find underneath all this was actually misregulation in terms of Basel III, in terms of Dodd-Frank in the U.S., and in terms of some other regulations around the world. This may actually have been a result of poor regulation as opposed to not enough regulation. And as an example, Ben talked about how well capitalized the global banks are, and indeed they are thanks to Basel III. However, one of the things that Basel III did was coming up with risk-weighted capital such that sovereign debt carried zero risk, and therefore banks needed no additional capital to carry sovereign debt on their balance sheet, which enabled Silicon Valley to double in size without adding $1 of additional capital. They added $90 billion. They put it in mortgage-backed securities with negative convexity. Talk about risk, yet zero risk-weighted capital. And that's just one. I mean, when you think about it, if Silicon Valley would have had $30 billion of capital on its balance sheet rather than 15, we would not have had this problem at all. Okay. Once we start peeling this back, I think we're going to find that the culprits are very different than what we've been reading in the papers these days or hearing from the regulators in the regulatory capitals of the world.
Yeah, fortunately, the speed that most regulators move at, I'm not sure anything's going to change in the near future. See what happens in the coming month, the coming year, and obviously reflect as well, like you say, Tony, on potential missteps and unintended consequences of previous regulatory actions.
Ben, that reminds me of the old joke, and I forget the exact words, but I don't know where we're going, but we're going to get there quickly, or I don't know where we're making good time. I'm glad that the regulators now have a tendency to move slowly, but I'm fearful because this is a very populist thing in the United States. Now they're talking about universal deposit insurance in order to save the economy. Well, fortunately that hasn't happened in the last 4 weeks, which means the probability goes down. But should there be another crisis, and there certainly will be at some point, the idea is now on the table. It's a bit disconcerting for me.
So the underlying message here is reflect before you regulate any further. What is your choice for the biggest or most important story of the past week and why? Ben, can I ask you to answer that first?
Yeah, I mean, I think for me, it's probably the banking crisis, but purely because of the potential scale and impact that it could have for corporate treasurers when that shakes out. It's certainly something to monitor, the next month, the rest of the year, really, just to see if the turmoil really has eased or if we're just, on the dip of the roller coaster and we're about to shoot back up again. And everyone wave their hands in the air and scream. So it's worth keeping an eye on some of those key indicators. And like I said, the fact that this has muddied the waters around central bank policy a bit, having a direct impact on interest rates that obviously treasurers that are looking at their cash management computations have to pay attention to, either say it's for short-term cash investments and where you can actually make the most of your money, or if it's actually impacting on the other side, on the debt side, and what's that forcing companies to deal with. So I do think that's kind of the overriding sort of headline issue for me right now out of the topics we've looked at today.
I'm aligned with Ben with a little bit different twist. The crisis has abated. As I look at the underlying statistics, what I'm seeing is still a movement toward better sizing balance sheets and redeploying assets and insured versus uninsured deposits. But what I see is a major shift in the last 2 weeks, as I look at the numbers, to an orderly transition rather than a panicked or disorderly transition. If we look at bank borrowings from the Federal Reserve over the discount window or through some of the new facilities, that is still increasing, but at a much lower rate. As we look at the flow of bank deposits out of banks and into money market mutual funds, which frankly I think they all should be, but that's just a personal opinion, that flow has decelerated, but is continuing. An orderly flow back to a more appropriate balance, I think is a very good thing. And that's a story I'm not seeing written anywhere.
Interesting. A great food for thought. Thank you so much, Tony and Ben. A great note of gratitude for your discerning analysis and precious insights. We would also like to thank our CTMfile audience for joining us on this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you, gentlemen. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.